Well, good morning, everyone. My name is Nicholas Reid from Reid Corporate, and I'd like to thank you very much for joining us this morning for this special Resources Rising Stars investor webinar featuring Coda Minerals, ASX ticker COD. Well, the outlook for copper, the red metal, has emerged as one of the strongest thematics in the resource sector this year. Because of its essential role in electrification, copper is one of the keys to the decarbonisation of the global economy. And annual demand is projected to double from around 25 million tonnes currently to 50 million tonnes by 2035. Put another way, over the next 27 years, the world is expected to consume nearly twice the total volume of copper it has produced over the last 3,000 years. At the same time, we're seeing very few new commercial discoveries and historically low inventories of the metal as the supply side equation becomes ever more challenged. It's against this backdrop that I'm very pleased to welcome Chris Stevens, the Chief Executive of South Australian copper developer Coda Minerals. Fresh from delivering a scoping study on Coda's flagship Elizabeth Creek Copper-Cobalt Project, Chris is here to give us an overview of the project and Coda's plans to develop a significant new mining operation in South Australia's copper heartland. Before handing over to Chris, a reminder to everyone listening to please log questions using the Q&A button on your webinar browser so that I can put them to Chris once he is finished presenting. Chris, thanks very much for your time this morning. It's great to see you. Please take us through the Coda story.
Thank you, Nicholas, and thank you for having us on the webinar. Look, thank you to everyone who's come on this webinar. And over about the next, I know the registration link says 2 hours. I assure you I'll be not talking for the next 2 hours. Over about the next 20 minutes or so, I'm going to leave plenty of time for questions. Feel free to put questions as I'm talking. If they're particularly relevant to the slide, I'll pause and answer them. Otherwise, we'll leave plenty of time at the end as well. I'm not going to stick rigidly to these slides, and I haven't scripted anything in enormous detail, largely because I think that the sort of fireside chat style of delivering this is just more open and authentic. And one of the things that I really want to do today is give you the background to this project, to what we put out yesterday. Those of you who have seen, I imagine everyone on the webinar has probably seen the announcement. Some may have read beyond the first 2 pages, which I think are a good summary, but there's an awful lot of detail in there as well about a project which I believe is very strong and has a fantastic future. And over the next little while, I'm going to talk to that. Just before I do, I'll probably make an observation and maybe address one of the elephants in the room, which is yesterday was not the best of days after 18 months of intense work, working nights, working weekends, putting together this study. To have what I would call at best a muted market reaction is sometimes challenging. What I will say, and if you're on this webinar, I assume that you're already very much on board with this point of view, is that often the first day reactions are just to a set of information and numbers which are not particularly well understood, well drawn out. And one of the things that I intend to do today is really make sure everyone's got the opportunity to understand this directly from the company itself, but also to ask questions and to make sure you get comfortable with that. I know, look, I'm a WA School of Mines trained mineral economist. I make my own investments as well, and sometimes those investments are not particularly well understood. So again, I thank everyone who's taken the time to come on this webinar and actually take the time to understand what we're doing and what this project really is, because I believe very strongly it is a good project, and I'll demonstrate that over the next half an hour or so. So again, I'm going to assume that everyone is very well understanding of these slides, of the background of the company, and I'm really going to dwell on the new slides and talking to the project and what we've put out in some detail. I'll draw your attention to the disclaimers. There's an extra page, not particularly easy to read. I will say that this is in more detail within the first couple of pages of the scoping study as well. This is important information, and everything I say here should be read in or should be understood in line with the disclaimers within that ASX document in particular that we put out yesterday. So in summary, and again, this is a scoping study. We've said in the document that many aspects of this are to a high level, and I do believe that just noting the sheer length and amount of detail of this study, hopefully people can see the sheer amount of work that's gone into that. And there's a couple of reasons for the amount of detail for what is essentially just a scoping study. The first is that this is a project that we have been involved in for a very long time. This is a project I know extremely well. I've been involved with it since early 2016 in one form or another. And that has driven a really deep understanding of what can and can't be done and how this looks. So again, I think this is a really comprehensive piece of work. The results, again, I think speak for themselves very well. A pre-tax NPV of $570 million. That's against a peak negative cash flow of $438 million. And I've had some comments around the CapEx. I mean, I personally think that this is a very strong capital efficiency. It is within its peer group, one of the strongest capital efficiencies out there. The IRR at 26.5% is the highest of any IRR I am aware of for copper producers. Sorry. Copper developers and copper feasibility stage companies on ASX right now. And those numbers, they really respond very well to the copper price and offer incredible leverage. So this is already a best-in-class study using just under spot prices which are used by overwhelmingly the majority of companies putting out studies at this stage. We did some research and the average price was about $9,000 used. A lot of companies used 8.8. I'd say the modal average was 8.8, with a few companies using 9.3, 9.5, and 9.6. We used $8,800 copper, which translates to $4 a pound. So I'll talk a little bit to the leverage to the upside as we go through. But at spot prices, this is a project that has one of, if not the highest IRR in its class at 26.5%. Very strong capital payback period of just 4.75 years. And I will emphasize that is all capital. That is phase 1 and phase 2 with a peak negative cash flow of 438. What that effectively means is the funding requirements of the project to build it, because some of the total capex, which is phase 1 and phase 2, are added together. But there is early cash flow, which reduces that funding requirement. So I believe these are very strong numbers, and I believe that they only get better when you look at them in the context of ongoing copper prices. It's technically and commercially robust. We have put a lot of detail in this project. This is not a project that for a scoping study has a lot of questions left unanswered, although there are a significant amount of packages of work and upside opportunities that are, relate to the scoping study. One of the interesting questions when you do a scoping study is the plus or minus aspect of the study. We have put this out at plus or minus 35%, which is in the probably lower bounds or upper bounds, depending on, the higher levels of confidence that a scoping study would normally come out. A class 5 estimate generally being between about 35 and 50% plus or minus. The reality is this is not highly sensitive to CapEx and OpEx, as can be seen in the sensitivity tables within the economics section of the study. It is obviously most sensitive to things like copper price and cobalt price, and as an extension of that, the exchange rate as well. But that does provide significant upside opportunity with that copper price as we move towards a decarbonized future. Again, in terms of the technical side of things, we are looking to produce very high value end products. And I was at a function last night talking to a number of analysts, and one of the things that came through very strongly was the support for the plan to go downstream. Making sure that we are producing products which are of high value, which are eminently saleable and reduce marketing risk for an additional capex in phase 2 of just over $300 million. This was seen, and this seems to be seen very much as a very great strength for the company. It doesn't involve expensive roasters or anything particularly exotic. These are relatively simple, well understood processes here. In terms of the infrastructure, you couldn't get a better location, to be frank. It's 40 k's from Carrapateena. It's just down the road from Oak Dam West. It's just down the road from Olympic Dam. We have access to fantastic infrastructure, roads, the nation's most renewable power grid, if not one of the world's most renewable power grids. And of course, being located in an area with extremely low sovereign risk. I haven't looked at the latest ratings, but South Australia generally comes in the top 3, if not the most favorable place in the world to develop a mine. And that really helps. And I don't think that should be discounted here as well. When you look at projects, and you look at the NPV, you look at the IRR, you look at the CapEx, but where it is really matters, and that's a huge advantage for us. So just looking at the corporate structure, the main comment I will make here is that volumes traded yesterday were quite low. The share price has rebounded this morning. At close yesterday, we were trading at about 4% against net asset value backing. Now, to put that in context, and this is where one of the opportunities lies, the average for the peer group is between about 15 and 25% at this stage, trading against NPV backing. And so we obviously have significant upside opportunity there. And again, the first month after delivering a study, we did some work looking at the effect of studies on share prices, and overwhelmingly the effect was tracking sideways or down for every company we looked at. And the group had about 18 different companies in it because we used a wider group than just copper. And so over the next month, I think what we're going to see is, a significant amount of research coming on this. People will be dusting off their copper research sheets. They'll be looking at this in the context of copper price forecast, and they'll be looking at this in more detail. Sophisticated retail investors, sophisticated analysts don't understand a 100-page document in the first half an hour of release. But they do over time. People take the time to come on webinars like this. I'm heading east for the next 10 days on Monday. I'll be going through Sydney and Melbourne. Diary's already very full, primarily with funds and high net worths. And again, we'll be out there talking to this project, which again, in the context of the peer group, I think is very strong. So a market cap of just $30 million, that screams buying opportunity to me. And that shows that we have work to do, no doubt, in terms of the promotion, and we take that on board, and we will be doing it. Again, directors, this was an interesting one. We submitted the study to ASX to review, which is not legally required, but generally considered sensible. And one of the bits of feedback that we were asked to look at, I don't think they'd mind me saying this, was they wanted more inclusion of board experience of taking projects of this stage through to the next stage. And I have to say, it was a very easy job for me to update the study with that information. We have a group who have a lot of experience taking projects through these stages. I realize most of you are familiar with the board, and if you're not, the bios are available, but it's a group of very serious people. It's a group of people with track records of delivering projects and financing projects and finding other commercial outcomes for projects as well. So this is, again, not a board that is inexperienced in M&A and commercialization matters. I won't dwell on this for very long. It's a slide that you're probably familiar with, but I'm just making sure everyone is aware of where this project is. Carrapateena, just 40 kilometers to the east. We're just a couple of hours drive north of Port Augusta and about 6 hours drive north of Adelaide. In terms of ESG credentials, it's absolutely spectacular. We have no significant heritage or environmental hurdles. We have an incredible relationship with the traditional owners, and we're very well served for infrastructure. I will talk to the exploration potential as well. Strange thing to do in a study webinar potentially, but I think it is incredibly important to understand. Again, when you craft that sort of first 2 pages, I really wanted to get across the ongoing potential of this project as well, both in terms of the IOCG exploration, which, for the avoidance of doubt, is not included in this study at all. There's a whole other group of mineralization on the tenure that still remains a fantastic exploration opportunity and is not included at all in the economics of this. There are other deposits and there are other opportunities which are at an earlier stage, which have also not been included, not least of which is the potential to extend mine life, either through extensions of other Tapley hosted mineralization or based on the ANT survey work, the potential to increase the size of Emmy Bluff. We have long been of the view that Emmy Bluff extends beyond the existing resource. We haven't been able to demonstrate that with a drill rig yet, but I certainly expect that we will be able to do that based on ongoing geophysics and exploration work. So that is a huge upside potential there. Increased mineralization driving that mine life longer will be a very powerful thing to do. terms of the copper price, look, I'm going to talk more to the sensitivity. So I think you have to make up your own view on the copper price. The leverage to the copper price is something that I'm very interested in terms of my own career. I believe copper is the best possible place one could be working right now. And I also believe for my own investing, and I have put my money where my mouth is, particularly in terms of this company, but also in terms of other copper companies that I find attractive. And I will say it is very, very difficult to find good copper leverage right now on the ASX or frankly anywhere. I personally believe this is the best leverage that can be found anywhere. And again, over the next few minutes, I'll sort of talk to that in more detail. This slide hasn't changed much again, so I'm going to just quickly run over it, but effectively 1.1 million tons of contained copper equivalent. Look, they said a year ago we couldn't mine it. A year ago, I didn't know that we could mine it. It took some time, it took some work, but we have demonstrated in this project, I believe, that we have a very credible mine plan. That mine plan looks effectively over 2 open pits, MG14 being the starter pit, high grade, a much higher grade copper concentrate, an eminently saleable copper concentrate that's reasonably in keeping with global standards and no deleterious elements. What this gives us is the ability to drive early cash flow and reduce that funding requirement from the full capex number down to the peak negative debt number by driving early cash flow. Also reduces technical risk, which is a fantastic thing. Hydromet plants can be badly behaved. In fact, all metallurgical plants take a while to tune in. If you're driving early cash flow from a very simple flotation plant, which tend to be a lot easier to get online and a lot better understood, then that reduces risk and helps with your debt service coverage ratios and all those good things early on. So yes, we're at a scoping study phase. There's an awful lot of amount to work before you get to a full DFS model, but this, I think, demonstrates the integrated thinking that we have at this project. Windabout, this is still a very solid production target here, 6 million tons at 1.71% copper equivalent. These are good grades for an open pit. A little bit more overburden, a little bit lower grade in terms of the concentrate grades. This will be fed through a hydrometallurgical plant. One of the things we did, and we talk about this plus or minus 35% at this stage, but I think this just demonstrates why the upside opportunities from a dedicated team can be enormous. The original mine plan effectively envisaged MG14, then Windabout, then ME Bluff. Now, I actually wrote my master's thesis on effectively optimizing mine plans to drive revenue versus just putting tons through a mill in a very, I guess, vanilla fashion. And so with that sort of experience and having mining engineers who understand this on a much more fundamental level than myself, what we did was we re-optimized that, and we basically increased the net present value pre-tax of the project by about $120 million by doing that. So I think that's an amazing example of work that can be done. I mean, if you think about that in the context of a 570 million NPV, that is very high value adding work. And we did this effectively by looking and re-optimizing the Windabout and ME Bluff interactions. Nothing particularly complex here, really just saying, okay, how do we drive the best grades and the earliest revenue in a sensible manner that can be achieved physically in the context of developing a mine? And that's what we've done in the mine plan that you see. So we've effectively moved some of the Windabout mineralization to the back of the production plan or the production target. So again, I talk about upside, but these are the sort of value adds that a dedicated team, I believe, can add. And we have quite a few more of them, which I'll talk about towards the end of the presentation. So I don't think you've seen the end of these value adding initiatives at this point. The production schedule, I'm just checking on if there's any Q&A coming. Sorry, I realized I was on the wrong one there. So I'm just going to look down the questions here before I go on. I think someone's just saying, you mentioned the scoping study could result in a re-evaluation in the share price. Do I still think so? Yes, absolutely. The metrics are very clear against peers, the enterprise value over resource, the enterprise value over MPV. As I said, we're trading at 4%, 5% of our net asset value backing on based on the MPV we put out yesterday. The average of the peer group is 15 to 25%. It's day two. There's an awful lot of promotion work and other work that needs to go. I'll talk to time to complete the PFS and the cost class estimates next to this level. But obviously, as I said, it's plus or minus 35% with significant upside as well. Richard's asked on PNG. I'll talk to that in a second as well, maybe towards the end, because that's a separate sort of initiative. And when can we expect more ANT results? Again, I'll talk to that in a second, but very shortly, very, very shortly. So as I move through those questions, apologies, I've probably segged a little bit, but I'll make sure I answer all of those as we go through. Just a reminder, if you have any more, please do ask them. So in terms of that production schedule, it's here. It's also in the feasibility study. I won't talk to this in detail other than what I've just said. But again, we're really driven by indicated resources here. We're driven by what I believe to be a very sensible mine plan with some additional upside optimization potential. And this is looking to produce 2.5 million tons through the mill for about 25,000 tons of copper at steady state with 1,000 tons of cobalt, which puts it in a very strong production. In terms of the processing, look, they said we couldn't mine it. Before they said we couldn't mine it, they said we couldn't process it. Now, a lot of that view was driven by some very quick and simple tests done in 96. That's 1996 when, how old was I? I think I was still at high school. So it was a while ago. And the flow sheet has taken a fair amount of work. This is the first thing we started working on. And we realized that most of the early tests had really been looking at suppressing the cobalt. Obviously, what we want to do is to get hold of that cobalt. And that's really driving that darker orange part of the flow sheet. So you can see here, phase one, very simple, very low capex. And there is the potential to just keep it at phase one. Although based on our current analysis, this has an inferior outcome by some way in terms of net present value, and it increases the marketing risk. There is a view, and I certainly hold this view as well, that that will change over time, and that people will start to look to pay for the cobalt units in certain types of concentrates. But ultimately, the lowest risk and highest net present value case based on our current modeling is to go downstream with that phase two. It's a relatively small additional capex compared to the additional value and the risk reduction here. And so I'm always happy to take questions on this. I'm happy to talk in more detail, but ultimately this is a relatively simple flotation followed by a very well understood and commonly used Albion process. I will say that pressure oxidation, again, we included this in the study, actually has a very similar outcome in terms of financials. So one of the things that you do in a pre-feasibility study is take your cases, which are usually multiple coming out of a scoping study, and you lock them down to one case to take through it into a DFS. So by the end of a PFS, we will have done that. The balance of probabilities at this point is Albion, but we maintain looking at both NONOx, which we released a little while ago as an opportunity, and pressure oxidation. NONOx is an interesting one because it changes the flow sheet more fundamentally than Albion. It effectively allows us to produce a cobalt sulfate and so that's a saleable cobalt product, but to have a higher grade, so upgraded copper concentrate. The reality is that has worked technically, but we have some more lab work that we need to do to understand residence times for the NONOx before we can accurately estimate a capex. So it kind of did what we hoped it would do, but we haven't been able to get to a reasonable basis. The delay to the ongoing study would be too much, so we've gone with the Albion base case. I talked about infrastructure already, so again, I won't dwell on this, but ultimately this is in an incredible location. And when you look at projects, do look at more than the net present value, the capex and the IRR. They are important, don't get me wrong, but they are also very fundamentally, it is very fundamental in the context of where you are mining. There is a big difference between trying to get off a project off the ground in the DRC versus getting a project off the ground in South Australia, as we've seen certainly with one or two projects recently as well. Especially for a junior. If you're Robert Friedland, things are probably easier. But if you are trying to make that transition, it is much harder. So heritage and ESG, I love this picture. The roofs are fantastic. But in terms of heritage and environmental risk, look, this is a very simple place to be operating. You can see here in this picture, it generally looks like the surface of the moon. There are no trees, no scrub around it. It's just low scrub around Emmy Bluff. We're in a green energy hotspot. It is an incredible place to be operating. I actually sit on the Minister's Executive Advisory Council for Energy and Resources in South Australia, so I have an inside track to South Australian plans. Look, I'm a proud West Australian and I love my home, but I will say I am very impressed by South Australia and the South Australian government. Not only are they an incredible group of people to work with, I enjoy our interactions. They are proactive, they are intelligent, they are very, very driven to make things work in that state. And the energy is a great example of that, but also the incredible sort of mining regulation. You're supposed to be positive about where you operate, but actually it's very easy to do that in the case of South Australia. These are good people. We believe that we will benefit significantly from friendshoring, which our geologist who wrote this assures me is a word. But ultimately, we are seeing inquiries and interest from strategic partners for Australia as well as Australia itself. We have applied for the Australian Critical Minerals Development Program grant. We believe that has very great strengths because, one, South Australia doesn't have a lot of similar projects on the critical minerals pathway, especially for copper and cobalt. We believe we have a very strong case, and we believe, or we certainly hope, that we may be successful with that, because what that would effectively do is allow us to look at some more, I would say, strategically interesting options, especially around the location of the hydromet plant. There's no reason it has to be next to the concentrator, and whether or not we can integrate other more stranded resources across South Australia. So again, the upside opportunities just from working in this place are fantastic. Okay, I'm going to take a, excuse me, I'm famous for my voice cracking, so I'll just quickly take a cup of tea. The opportunities here, excuse me. So let me talk about CapEx. I've seen a couple of questions on NPV and CapEx as well, so I'll answer these as I go along. The economic assumptions we believe are very conservative. We are a relatively serious group. Sometimes I wonder if we should try and play the game a bit harder, but ultimately I believe that when you're looking seriously at getting people who are sensible and who do their research interested in these projects, the best thing to do is to play an extremely straight bat. So again, 8.8 copper price, there's a lot of upside opportunity there. The cobalt price, we've used a long-term forecast. I will say with cobalt, it bounces around a fair bit, but the long-term average does seem to be around that $55,000 to $65,000 a ton range, and that's what we've taken from benchmarks. Benchmark Minerals, who are the world's sort of foremost experts on cobalt, their long-term average. Silver price is around spot, as is zinc, and again, I think we've used quite conservative assumptions here. In terms of the economic outcomes, talked earlier to this, but 317,000 tons of copper at a steady state average of 25,000 tons per annum. This is a lot of copper. This is enough to get people's interest. No, it's not quite of the scale of BHP's Olympic Dam, but I will say this very clearly. I talk to a lot of these people in larger companies, both here and overseas, and everyone is of the same view. The future of copper is unlikely to be in large projects. Very, very, very unlikely. It is likely to be in putting together sensible, smaller projects within districts. This comes straight from a number of companies who seem to have the same view of the larger companies. And again, I believe that that makes a lot of sense based on my own knowledge of the copper market. So again, $5.7 billion of net revenue, the undiscounted net cash flow at $1.3 billion. Fascinating thread on one of the social media websites that I won't name yesterday about discounting. I think there's some very strange things written on the internet. What is actually the case is that the net present value at 8% discount rate, $570 million. There's a question here on sort of what rate of interest for debt would be a source of funding for the next phase. It's a very good question. It's one that we will answer as we go through the next phases. We believe a net present value 8, or sort of a discount rate of 8%, is very common, very usual. Again, we've included, so obviously the discount rate is a function of your cost of capital, and we've included sensitivities on that within the main document. It's obviously not highly sensitive to discount rate, but everything is a function of each other within those sensitivities when you look at it in terms of funding a project. So the cost of capital is something that all projects face. Is common to us. I will say most companies seem to be putting out NPV 7. We've gone with NPV 8, which is more conservative. Peak negative cash flow, as I said earlier, 438. The reason that's lower than the CapEx is very simply that there is early revenue from that. Now, comment about playing the game. Most companies only really put their pre-production CapEx within the first bit of the study. We have taken the view that, I don't like to play cynical games. We've disclosed the entirety of the CapEx. But when you're comparing projects, make sure that you look within the full CapEx tables. What we have done, it's been very clear that total phase 1 and phase 2 CapEx of 597 and that the payback period of 4.7 years is inclusive of those two. A lot of companies don't do that. I won't name them. But I do think that it pays to be very clear and to be very open with shareholders about those funding requirements. How will we fund it? There's a question come through. I think it's worth dwelling on this briefly. My response is generally, how does anyone fund a project? I mean, ultimately, it is a mixture of equity. It is a mixture of debt. But there are, and again, this is a function of another question come through, which is that, are we looking to become a producer? The answer I'll give is the answer I always give, which I think is a sensible one, and it's the only one I have, unfortunately, which is that you must always work as you are going to take it right through to rehabilitation. Otherwise, it drives bad behaviors. Otherwise, it drives shortcuts. I'd like to think it won't, but it does. And so you have to always work that you are doing the absolute best. If you just hand this over to another company and go and sit back in the office and wait for results, you will not get a good result. You will not, you just outsource the whole thing and hope for the best. Good outcomes are driven where there is a strong owner's team. That is always the case. That never deviates from the case. If you see companies without a strong owner's team, it will not end well. And that is something that I think most people would struggle to argue with. And so what we're doing is building a strong owners team. We're building strong inputs into this study, and we're driving the right behaviors as we go through. Ultimately, I believe that this will be very attractive to other companies. When you put out a scoping study, you are putting out effectively you're staking a flag in the ground of this is what the project is, this is what it can be, this is what the upsides are. We have a data room available. Anyone would like access to the data room should approach the company as well. Obviously, for a CA, the data room is quite active. It is very detailed. It includes the full suite of all of the documents behind the study, as well as the financial model. The short answer is that funding is likely to come from a number of potential avenues. The first, in the early stage, critical minerals grants, ongoing equity funding. The good news is that the next stage of work is relatively low cost. We're already indicated. The primary cost of going to next stage with most projects is getting from inferred to indicated. You'll see most scoping studies have a much higher amount of inferred within the mine production target. There are a number of private equity groups out there who are looking for exposure to copper right now. There are end users, so companies that are generally based in China, Korea, Japan, but also in Germany, the US, and other parts of Europe that are looking for offtake for copper with 25,000 tons per annum. This is a very credible production. This is not a small project by any scale. The ability to produce copper cathode is also extremely attractive to end users. And even more importantly, the ability to produce cobalt sulfate is effectively a direct battery grade mineral, which you see very rarely from projects. And so there are some great strengths to this project. So private equity groups looking for upside, end users looking for access to the copper and willing to fund projects in stable jurisdictions, especially to get access to 1,000 tons of cobalt sulfate at what is expected to be a battery grade. There are obviously miners, companies that are looking for, they see themselves as strengths to mine, and that is certainly something that we expect having the scoping study out there to attract attention. And of course, there is the potential to continue pushing this forward ourselves directly, and we are generally doing that. One of the interesting things I find is the emails that effectively say, why aren't you doing X? I get them quite often, 2-3 times a week at least, sometimes more. And it's an interesting one because obviously running the company on the inside, you know exactly what's going on. I write a very detailed report to the board every Friday as well, so the board knows what's going on. And generally, you have that information. But it's a really difficult question to ask. Why aren't you talking to X company? Well, how do you know we're not? And certainly, again, I say I wouldn't see that we would be doing our jobs if we were not pursuing aggressively and diligently every opportunity there. So there are multiple opportunities to take this forwards. With a 26.5% IRR, this is, in my opinion, best in class. One of the challenges is with a 4% net asset value backing as of this morning, we want to make sure that we drive that share price and get the right input at the equity level to make sure that any ongoing funding is non-dilutive. The good news is we have $6 million in the bank. Good news is I'm not planning to sell any of my shares. So the share price in the short term is relevant, but it is not strategically important in the short term. In the medium term, obviously, one of the things we're working on is making sure that we get out there, promote this. And again, we're on day 2. So again, I expect a study of this quality to start getting really serious attention and to really drive that forwards. So hopefully I've answered that question, because it does seem to be the question that comes up every single day. The flippant answer is, how does anyone fund this? The much more detailed answer is, with a project this attractive, with this exposure to the upside of copper, I would expect this to get a lot of potential avenues. The trick here is making sure we get the right potential avenue. And I won't be apologizing if we take a little bit of time, I'm not talking forever, to make sure that we push ourselves up that value curve to get the next stage of value creation work done. Certainly wouldn't want to lock in a price right now until we've finalized some of the initiatives I'll talk about on the next slide, and to continue pursuing some of those opportunities diligently. So sensitivities. Fitzy wrote a great article this morning in Resource Rising Stars. It's the first thing I read when I woke up this morning, and thought it was really good. This is someone who really understands what he's talking about. One thing, and it's probably our fault, that was maybe missed in that article, is that he commented we didn't take the leverage to copper beyond 20%. We did. ASX doesn't like to direct, upside sensitivities sort of plastered all over a document. So it is in the economics section. I apologize to anyone who's missed it. We put it on this slide here. What you can see here is incredible leverage to copper. If you have a view that the copper price is moving north, which I certainly do, I think this is a $200 billion market. I think that copper supplies are dwindling. I believe that copper is integral to a decarbonized future. Whatever your politics is, the world is moving that way. So it doesn't really matter what you think or I think. It's the way the world is going. And I personally think that's a good thing, by the way. We are going to have to mine more copper over the next decade than I believe we've mined over the last 3,000 years. And the likelihood of copper moving very strongly is very high. I think if I'd have told you in 2004 that the iron ore price wasn't going to be $20 a ton, it was going to be $100 a ton, you might have laughed at me. If I told you it would hit $240 a ton, you would have laughed me out of the room. The reality is that's exactly what's happened on copper. That's also a trajectory that has happened. That's happened with iron ore, and that has happened with oil and gas as well. And so the potential upside opportunity here is enormous. This is a project that makes money at spot, makes good money at spot, best-in-class IRR, but it makes more as the copper price moves up, and that leverage is very strong. Over $2 billion of net present value pre-tax at $15,000 copper, which is only $4,500 above the recent copper high, and is what Goldman Sachs is forecasting. You have to do your own research and ultimately form your own view on this. But if you're looking for copper leverage, I believe this is something that is very strong. Now, ultimately, we can't control the copper price, and that's something that we're going to have to work with. But I'm sorry, I've just got a couple of questions here. I'll pause briefly. Was the mining for open pit and underground assumed to be owner, operator, or contractor? Obvious capital and operating cost implications. The mining was assumed to be contractor. That does have capital and operating costs implications. I assure you that was modeled very carefully, and the model was peer reviewed. The costs for contractor mining, we used Mining Plus, which means the cost estimation used for contractor mining was used from the book of a existing mining contractor, Burncut. And so that information should be very up to date and should be very accurate. We quoted it at plus or minus 35%. What level of contingency with respect to cost and schedule were assumed? I wanted to answer this question while the sensitivity was up. We assumed 10%. We did a pretty comprehensive review of what other companies do. I will say the average, So the average was about 10%. So one company used 20. Most companies used 0, which I thought was a little bit cynical. But the CapEx ultimately is not wildly sensitive, or the project is not wildly sensitive to CapEx. We have a lot of work to do. This is a scoping project. I think 10% is on the low end, but again, you can see it's not super sensitive to that. But again, we will need to do more work on that as we firm up some of those as well. But yes, we did use contingency. What is your counsel on the best time to buy more shares? I'm too pretty for prison, so unfortunately, I can't answer that question. Joking aside, we're not allowed to make recommendations on that. What I can point you to is the net asset values, and if you do your sort of own research and look at some research output, you can really look at that against peers. So effectively the net present value divided by the CapEx to get capital intensity, net present value divided by the enterprise value to get backing against NAV. But unfortunately, I can't answer that question. How much cash do we have at the moment? $6 million. How are we funding to fund phase 1 of the plan? I've talked about funding already in terms of the next stage. Most of the critical path is really heavily driven by a couple of things. The first is upside opportunity initiatives, and the second is approvals. Most of the cost of that is already sunk or can be done in-house. So this is a relatively low cost next stage, which is fantastic. We're reasonably well funded for that. In regards to taking on a partner, is that still being considered? Absolutely. Partnerships are being considered both for us taking the ICG further. I'll talk to that in a moment because there's some interesting parts of that. And also in terms of the project, we are open to everything. We are not open to doing a bad deal, and we're not open to doing a deal at the wrong time. And so therefore, as I said earlier, just because it's not out there, don't assume we're not pursuing aggressively all opportunities. I assure you we are. When will the outcome of the critical grants application be known? Not soon enough, May, but we remain very hopeful. Again, I think we have a very good case for that. So hopefully that was probably a good time to answer those questions. Just a couple of minutes more to talk. Upside opportunities, mechanical cutting. This is an alternative way of mining Emmy Bluff, in particular, well, Emmy Bluff. It would be using effectively a form of continuous miner, generally called a roadheader. We've been down this study work for a while. It's still ongoing. It has the potential to make life a lot easier in terms of ventilation, in terms of the cutoff grade. Mechanical miners generally are much more selective. They generally, subject to the hardness of your mineralization, have much better productivity rates and much lower manning or personnel requirements. So again, does that have a material opportunity there? Absolutely, it's enormous. I can't quantify it, and I certainly am not allowed to quantify it at this point, but it is a very significant upside opportunity, and we're working through that. XRF ore sorting. This effectively means underground, you're looking at making sure the best mineralization is what comes out on top. This comes out of the mine underground. This say uses an XRF technology. We've had really good data, which we included in the study. This has the potential to lower cutoff grade. So effectively, if you can lower cutoff grade, but get rid of anything that is not of an economic grade to go through a mill before it hits the mill, you can mine much faster, you can mine much cheaper, you can mine less selectively, you can get rid of the rubbish before it hits the mill. Win-win, reduces costs significantly, increases the grade of the stuff going into the mill. As I say, early stage work has been positive. This again is a big potential increase in the net present value. Acid neutralization, there's dolomite locally. These numbers potentially are quite large. The cost of moving limestone for part of your processing plant is primarily moving it. So the cost of getting limestone is primarily transport. It's very and it's also a carbon intensive thing. Very few projects have limestone on the tenure. And so this is a great opportunity and quite large. Exploration expansion. So again, this is probably a good time to talk briefly about all of the opportunities here and the opportunities to expand. Richard asked a question about PNG. Do you have a project in PNG? It's got incredible historical hits. PNG is an increasingly difficult place to operate. We are still negotiating for the grant of that license. Probably wouldn't hold your breath, but the opportunity there remains significant, and we remain very lightly focused on this. This is a very low cost, moderate energy endeavor, but we're certainly pushing that hard, and that application remains live. terms of Elizabeth Creek, obviously 99.9% of our focus. We have the Emmy Bluff geophysics. So the geophysics we ran with the ANT has identified structures that correlate very well with the drilling for both the Tapley hosted mineralization, the copper cobalt that I've been talking about for the last half an hour, as well as the IOCG, the deeper mineralization. We have people in the field right now running tight space gravity. We have a geophysicist who is one of the world's most experienced Gawler Creighton IOCG geophysicists working on this. He's incredible. That was one of those amazing lucky finds, sort of luck and hard work and a lot of searching. And we expect to see results very soon. So somebody asked the outcome of that. And again, that will be out soon. What we're hoping to see here, we've seen a bunch of stuff in the ANT. We've put out a little bit of information. We will follow that up very shortly. What we expect to see is a correlation against the tight space gravity. It's a fundamentally different way of looking at what's effectively below the ground, looking for structures. I will say we took quite a tight spaced conservative approach to drilling out Emmy IOCG, which sits beneath Emmy Bluff. Whether or not that was the right approach, it was the approach based on the knowledge that we and our independent consultants had on how IOCGs basically form. You generally get a progression from chalcopyrite, which is barren, to a lower grade copper chalco, to bornite, and then back again. What we've seen, which is very strange, is 3 of these little things. So they don't look like a big diffuse IOCG, which is what the sort of, I guess, the failed IOCGs on the Gawler Creighton look like. They look like the successful IOCGs, just smaller and sitting in the metasediments. What we expect to see is a structure that's pushing that grade of copper in there, but would give us the space and effectively the space to brecciate, to crack up, and to drop out significant world-class amounts of copper. That's what we're looking for. The next stage with the IOCG is actually relatively simple. We have a hypothesis. We would like to test that, whether that's organically through our own funding efforts. And again, as I expect to see copper moving towards this year and we get support from the study, that may become more possible, or through partnerships. I believe that is a target that is worthy of testing. We have more work to do before we can refine that hypothesis. So right now, the hypothesis is that we're chasing a structure that has created enough space that so far hasn't existed within the existing Emmy IOCG to drop out a world-class tier 1 IOCG. The next stage of work should basically confirm that hypothesis. We certainly hope we'll confirm that hypothesis. We'll put those results out, and then we will look at how we develop that opportunity going forwards. Average life of mine cost per ton has just been asked. Isn't the feasibility study in detail? Apologies, I think I've had so many facts in my head, it's just disappeared. And the minute I come off this call, I'll remember. But I will point you towards the mining section, the economics section of the project scoping study. Next steps, look, this is pretty open and woolly, to be quite frank with you. We know exactly what's happening over the next 6 to 12 months. A lot of this depends on the outcome of the next stages of work, but ultimately we're pushing hard through to a PFS. I would like to, under promise and over deliver on this, but really getting that next stage PFS. What do we have to do for PFS is maybe a better question that I should answer. The first is we need to continue pushing forward the critical path. That's approvals driven, that's studies driven. You've got to do your spring survey in spring, you've got to do your autumn survey in autumn and post rains and all of that. So that's ongoing in the field. We have an excellent operations manager working in the field with us. That's relatively low cost. We will be pursuing those upside opportunities very, very aggressively, especially the mechanical cutting and ore sorting, because they're both game changing if they work as we expect. We're also pursuing non-ox, which again, if all 3 of those come off, again, that's an incredible uplift to an already very strong project. We'll need to do a small amount of drilling to gain geotechnical information and sample, piloting and feed, and that will give us a PFS. We're very advanced on most aspects of the PFS. So again, I think that's a very strong part of that. I've been asked repeatedly who's been involved in this. The financial model was reviewed by CSA Global, Strategic Metallurgy, and Osenko heavily involved in the process plant. Mining Plus, just awesome people. In fact, everyone we work with are great because we don't work with anyone who isn't. But Mining Plus, incredible underground as well, and Green Values that we've worked with extensively for many years now. on the progressing the approval side of things and heritage as well. Glencore Technology working with us on Albion as well. Household names, phenomenal people, great consultants on an individual and level as companies, and we're very lucky to have them. We worked very hard to make that work. Now with this, I'm going to pause the slides, just come back to myself and give opportunities for any more questions. Hopefully I've given you a really good understanding of where we're sitting, what we're trying to achieve. Again, I believe these are very strong outcomes. I'm going to be on the road for the next 10 days, absolutely talking sophisticated. We're on day 2. We will be running another webinar. This will be on the 20th of April. It's what I'm calling When the Dust Settles webinar, the other side of the Easter school holidays as well. I would very strongly encourage everyone. We're going to get our chairman to speak at that. We're going to get our exploration manager. It's going to be a longer format. There'll be an agenda, so you can come in and pick and choose which bits you want to attend, but it'll be close to a half day where you can really get to understand the next stage plans of the company. And again, we will answer a lot of those pre-feasibility questions in a lot more detail at that as well, with some of the forward work plan. At this point, I wanted to focus on what we've just released. In about a month's time, we will offer that much more in-depth opportunity as well. So with that, I don't think there are any more questions. If I've missed any, let me just check. I don't think I've missed any. But if I have, info@codaminerals.com comes straight through to me. I'll always call you back if you leave a number. But the best way to get us is info@codaminerals.com. And with that, thank you very much.
Thanks very much, Chris. I'll just by way of wrapping up, you're going to be on the East Coast over the next 10 days. So if anyone does want to catch up with you, they could just reach out to you direct.
Yeah, again, either chris.stevens@codaminerals.com or info comes through to the same box. Just reach out. I'll be in Sydney from Monday to Thursday next week, and I'll be in Melbourne next Friday and next Monday, and very happy to catch up. I don't care if you own 1,000 shares or 10 million shares, you will always get the same level of respect, and you will always get an answer to your questions, a call back. And if you'd like to catch up here at the office or while I'm on the East Coast, I'll be very happy to buy you a coffee.
Thanks, Chris, and thank you for very efficiently dealing with those questions as you presented. That's a good way of running a webinar. Just a reminder to everyone watching as well from our RRS network that Chris will be presenting at our annual Gold Coast conference on the 16th and 17th of May. It's our 20th anniversary conference, and we'll have our program released just before Easter, so look out for that. So look, we won't prolong things. I think we've covered everything very well. Chris, thanks for your time this morning.
Thank you, Nicholas.
Good luck with the roadshow, and I'd just like to thank everyone for watching our webinar. We'll be in touch with our next event very soon. Thanks very much. Have a good day.
Thank you, everyone. Thanks.